Hi, my name is Andrew Hallam. I'm the author of Millionaire Teacher and Millionaire Expat. Today I want to talk to Canadian retirees. Many of them are really concerned about what they should be doing with their investment portfolio given the COVID-19 crisis and the volatility that the markets have been experiencing. It's natural to not know where to turn. Do we pull your money, or should you pull your money into cash to mitigate any future losses, or bonds, or do you put your money into gold, or even just a little bit of each? I want to try to persuade you not to do any of that, but to stay the course and maintain a globally balanced investment portfolio. Here's some perspective. From January 2010 to April 2019, we've seen some really substantial gains. This chart doesn't show you how much the stock market has grown over these 9+ years. The stock market's grown, both the Canadian and the US market has grown considerably faster than this. This chart instead shows you a globally diversified investment portfolio. 40% bonds, 60% stocks, whereby the stocks are split between Canadian stocks, US stocks, developed international stocks, and emerging market shares. You can see that if somebody had invested $10,000 in January 2010, that by April 2019, if they'd invested $100,000 January 2010, by April 30th, 2019, they would have $226,314. I'm showing you this just for perspective. And you'll see why as this presentation progresses. Been some really substantial gains. Unfortunately, what we're affected by more often than anything isn't so much market returns, but it's our responses to the market. The biggest enemy we face isn't a stock market drop, it's our own behavior and how we respond to stock market drops. We often look to gurus. We look to people that supposedly can see the future, the smart money, so to speak. Many people will turn to hedge fund managers looking to see what are they doing with their money. And it's really quite tantalizing to see a magazine cover or an article about what the hedge fund managers are doing right now. Are they pulling money into cash? Are they hedging against the markets, whereby they're expecting the markets to drop, whereby when they hedge against it, they can actually make profits by betting it will drop and then collect on those profits? Or are they pushing money into gold or specific stocks or bonds? Here's why I want to suggest that you do none of that at all. Hedge fund managers are smart, but the smart money really isn't all that smart. Let me explain. A hedge fund manager has his or her finger on the pulse of the economy. They're moving their money tactically, trying to figure out how to do best this month or this year. They're not typically trying to think long term. And as a result of not thinking long term, they end up with really poor results. So much so that the typical hedge fund in the United States underperforms a box of cornflakes over time. Cornflakes. I'm talking about cornflakes as it relates to the CPI index, which is inflation. The average hedge fund in the United States, as represented by this orange line here, has underperformed inflation despite all of their tactical moves. And that's why I'm suggesting that you don't try to tactically move your money around. We are not typically smarter than a hedge fund manager, and hedge fund managers on aggregate end up being really poor asset allocations, despite the myths that are associated with their success. Instead, if you maintained a globally diversified portfolio, 60% stocks, 40% bonds, over the same time period, as represented by this gray line, you would have turned a $10,000 investment in 2003 to about $35,000 by the end of 2019, leaving the hedge fund managers long in the dust. Maintain a diversified portfolio of low-cost ETFs or index funds. It's essential that your investment costs are low. If you're investing your money with a typical Canadian bank or a typical Canadian mutual fund company, you could be paying investment fees of 2.5% per year or higher. To put that in perspective, if an investor ended up making 5% return before fees and the financial service industry took 2.5% away from them in terms of fees annually, then the investor is giving up 50% of the pre-fee profit to the financial services industry. We don't want to do that. That's why we want to make sure that we maintain a globally diversified portfolio that's low cost. Here's a sample that would work well for a retiree. 30% in a Canadian stock market index, 40% in a Canadian bond market index, and about 30% in a global stock market index, which would have included exposure to the US stock market, developed international markets, and emerging market shares. Well, how would such a portfolio have performed so far during this crisis? Recall that I showed you how that same portfolio would have performed from January 2010 until April 2019. It would have gained about 126%. It's really important that we focus and appreciate the gains that we do make. When we look at economic research or behavioral research, we look at, well, Daniel Kahneman won a Nobel Prize in behavioral economics, and he and his former research partner, Amos Tversky, ended up finding that investors dislike losses twice as much as they enjoy gains. So we completely forget about the gains that we've made, and we focus only on the short-term losses. We completely forget that a globally diversified portfolio from January 2010 to April 2019 would have gained about 126%. But we focus more instead on the drops, and that is what can influence our investment behavior and cause us to do something silly. How would that portfolio have performed over the 12-month period ending April 10th, 2020? Well, that globally diversified portfolio, 60% stocks, 40% bonds, over the 12 months to April 10th, 2020, would be down 3.99%. If it were more conservative and it were 60%, had 60% allocated to bonds and 40% allocated to stocks, it would be down only 1.64% over this 12-month period. Of course, such a portfolio that had higher allocation to bonds, although being more conservative and although being less susceptible to market drops, also doesn't gain as much when the markets recover. But we focus on this. Just the drops. We don't typically look at the big picture. What has been the return over the past 12 months? Negative 3.99. And what was the return over the previous 9 years? Plus 126%. We want to make sure that we keep perspective, we keep calm, and carry on. The markets may drop significantly. They probably will drop significantly several times, I know, during my lifetime and perhaps during yours too. That's why it's best, though, to maintain a level of emotional equanimity throughout any kind of market volatility. Well, what if you retired at a horrific time? Well, one of the worst times to retire would have been January 2000. If you retired then, just a handful of months later, you would have faced a global stock market decline of 47%. To make matters worse, just a handful of years later, in October 2007 to March 2009, the global stock portfolio would have fallen, global stocks fell 50%. This is pure stocks now, not a globally diversified portfolio. Still, very, very frightening. What if you retired January 2000? It really would have been one of the worst times to retire. But I want to look at, before focusing on that, I want to look at RRIF withdrawal rates. The federal government mandates that a retiree take out a certain percentage of their investment portfolio each year depending on their age. In 2020, the federal government is actually being quite kind to retirees. They're saying, okay, we know there's a lot of uncertainty. You're afraid to be pulling money out of your account, especially if the markets drop. So instead of a 70-year-old being mandated to withdraw at least 5% from their RRIF portfolio, the federal government has reduced that amount. It'll be probably around 4% that they'll be able to withdraw in 2020. Well, let's get back to that couple, let's say, that retires in January 2000 at a horrific time to retire. Let's assume that they withdraw a constant 5.5% from their portfolio each year. This, I realize, isn't realistically representing a RRIF portfolio because many retirees will be withdrawing less than that when they first retire from their RRIF and more than that later as they get older. But we'll just use this as an example just to show how resilient a portfolio can be even when the retiree retires at one of the worst possible times in history and faces a couple of horrific crashes. Here are the withdrawals in dollar figures that would be taken out each year. As you can see, the retiree starting with $100,000 would have withdrawn a total of $118,062 by the end of 2019. That's fascinating in itself because they would have withdrawn more money than the portfolio was actually worth when they retired, and they would have gone through two of the worst market crashes in history. And they still would have had money left. This chart represents the balance of the portfolio over time. You can see that despite all of those withdrawals, despite the fact that they took out $118,000 from the initial $100,000 portfolio, by March 31st, 2020, the investor would still have just over $90,000 remaining. By mid-April, of course, the markets had recovered a bit, so this would be closer to $100,000 by mid-April. This, however, is only if the investor had a globally diversified portfolio, they kept calm, they did not speculate. During the market crash of 2000 down to 2002, they did not speculate 2008 and 2009. Easier said than done, but it's essential for retirees to remain calm and to not speculate with their money. Keep calm and carry on. I'm Andrew Hallam, author of Millionaire Teacher and Millionaire Expat. If you like this video, please click like, post a comment, and I hope to see you again. Thanks so much. Bye-bye.